All right, so today we're going to be doing a deep dive. We're going to be looking at a recent interview with Dan Haw.
Okay.
He's a partner over at Corn Asset Management.
hmm
And this interview is from the YouTube channel Global Money Talk.
Oh, I've seen that one.
Yeah, yeah. So basically what we're trying to do today is figure out, what are some of the key takeaways from this interview, and how can we apply those to, our investment strategies, our own portfolios. And what really jumped out at me right away was Dan Haw emphasizes this disconnect between how the market reacts to the news versus how the actual underlying reality changes.
Yeah. It's like he used the 2020 election
Oh, right.
is a really good example. The market was going crazy with all these predictions. But, I mean, come on. November 7th, it wasn't that different from November 4th.
No, not at all. I mean, it's really easy to get caught up in the moment, especially with how fast information travels these days. So I guess what you're saying is, if we're thinking about applying this to our own portfolios, maybe it's better to kind of stay the course, even if the market seems a little volatile, as long as, of course, the companies we've invested in still have, strong fundamentals.
Yeah. I think you're picking up what he's putting down. It's all about looking beyond those knee-jerk reactions and just kind of focusing on the long game, like separating the signal from the noise.
Right.
And sometimes that signal is telling us, you know what? Not much has fundamentally changed.
Yeah.
Even if the market is having a meltdown.
Right, exactly. So maybe instead of, frantically checking our portfolios every time the market lips, maybe we should be looking at the bigger picture.
Right.
Are the companies we've invested in still innovating? Are their earnings still solid?
Yeah.
I mean, those are the things that really matter in the long run.
Exactly. Those are the questions that'll tell you if that market dip, is it something to really worry about? Or is it just, a blip?
Right. That's a great way to think about it. Now, Hawk also talked about tariffs and how they could be a major factor in this shifting market landscape. And it seemed like he was particularly concerned about their potential impact on businesses in Asia.
Yeah, and it was interesting how he kind of used these anecdotal stories to illustrate his point. He mentioned that a lot of his contacts in Asia, people who were really plugged into the business world, that they were expressing some real anxieties about the potential impact of tariffs, how this could ripple out and affect them. So it's not just theoretical. It's like this is impacting real people on the ground.
Right. And this is where it really hits home for investors like us, right?
Yeah, totally.
Because it shows just how interconnected the global market really is. I mean, decisions made in one part of the world can have a ripple effect. They can impact investments, even if those decisions seem like they're happening, a million miles away.
Yeah, for sure.
So I guess it really underscores the importance of staying informed about global events and, just considering their potential downstream effects.
Absolutely.
So, for example, if you're invested in a company that relies heavily on exports to Asia, then you really need to factor in how this potential tariffs might impact their, bottom line.
Yeah, definitely.
It makes you realize that investing isn't just about picking stocks. It's also about understanding, kind of the bigger picture, the web of relationships that drive the global economy. Now, another thing that I talked about was the changing regulatory landscape, especially for industries like big tech. And I thought it was interesting how he used the example of Tesla to illustrate how complex this can be, because he pointed out how Tesla's stock actually rallied despite the fact that there are all these, potential challenges stemming from a tougher stance on China. And it seemed counterintuitive, but he attributed this to, the perceived benefits of a less regulated business environment.
It raises a really interesting question, though, right?
Yeah.
How do we figure out, as investors, how do we sort of decipher the impact of political rhetoric versus the actual, boots on the ground implementation of policy in different sectors?
Yeah.
Tesla's a really good example of how those two things, those two forces can have very different effects.
Yeah, it's almost like a game of chess, trying to anticipate how each move will affect the overall board. So I guess what we need to do is, instead of reacting emotionally to headlines about regulatory changes, we need to really, dig deeper and analyze how those changes might actually play out in the real world.
Exactly. And that's where having a good understanding of the industry and how the company's business model works really, really comes in handy.
Right. Now, for those of us who are maybe venturing into international markets, had some interesting things to say about ADRs,
Okay.
American Depository Receipts.
Mm-hmm.
At first glance, they seem like a, pretty straightforward way to invest in foreign companies.
Yeah, yeah. They make it easy to access, for sure.
Right. But, and this is something that Haas really emphasized, ADRs don't actually hedge against foreign exchange risk.
Yeah, that's a detail that a lot of people miss.
Yeah, it's a big one.
Yeah, really critical.
So even if the company's stock is performing well, in their local market, our returns could still be significantly impacted by just fluctuations in currency values.
Totally, totally.
So it's really important for investors to understand how currency fluctuations, how those can impact their ADR returns. Especially if a large portion of their portfolio is, allocated to international investments, it's a good reminder that international investing has its own set of complexities, and, we need to be prepared to manage those risks.
Absolutely. And he does give some strategies for managing this risk.
Okay.
Things like hedging techniques, which are worth looking into if you're thinking about investing in ADRs.
Yeah, definitely something to keep in mind. Okay, so shifting gears a bit, he also shared a really fascinating insight from his conversation with market strategist Tom Lee about the lengthening of the U.S. business cycle.
Okay.
And what stood out to me was his explanation that this is due in part to the growing dominance of the service sector.
And why is that such a big deal?
Well, he explained that the service sector is inherently less cyclical than manufacturing.
Okay.
If you think about it, manufacturing relies so heavily on, physical goods and capital investments,
Mm-hmm.
which are more susceptible to economic downturns. But services, on the other hand, they tend to be more stable, less reliant on those cyclical factors.
So does that mean that recessions, they might be less frequent or less severe in the future?
Well, that's a question that he discussed with Tom Lee. And, it really challenges that traditional view of how we think about economic cycles. They both agreed that cycles are necessary to, as he put it, quote unquote, clean house in the economy.
Mm-hmm.
But he was saying that, that doesn't necessarily have to mean a massive economy-wide recession.
So are they saying that we might see like smaller, more targeted recessions?
Yeah,
Within specific sectors or industries?
exactly.
Like almost like a micro recession that, allows for adjustments without dragging down the entire economy.
That's exactly what they're suggesting. It's a much more nuanced view of economic cycles, and it really challenges that conventional wisdom about, how we should be preparing for them. So it makes you wonder, if we're potentially moving toward a world with a longer business cycle and potentially less severe recessions, how does that change, our approach to investing? Do we need to rethink all those traditional strategies that were, built around the assumption of regular booms and busts? That's a big question. But before we get to that, there's another big topic that Hopper brought up, market concentration.
Okay.
He pointed out that the top 10 companies in the S&P 500 currently represent a historically high percentage of the total market cap. It's rivaling some of the major peaks that we've seen in the past. And I don't know about you, but when I first heard that, it kind of sounds alarming.
Yeah, it does. It does. Sounds a little bit like putting all your eggs in one basket.
Yeah, exactly.
But he actually brought in some really interesting evidence, from Morgan Stanley research, suggesting that these periods of rising concentration, that they often go hand in hand with stronger market returns.
Wait, so you're saying that a more concentrated market could actually lead to better performance? How does that work?
Well, one theory is that, as you have a smaller number of companies that become really dominant, they're often the ones that are really driving, innovation and growth.
Right.
In the overall economy. They've got the resources, they've got the reach, they can really move the needle, which can translate into higher return for investors.
That's a really interesting perspective. But doesn't that also mean that the risk goes up?
Yeah, for sure.
What happens if one of those dominant companies, what happens if they stumble?
Yeah, you're absolutely right. That's the flip side of this, right? And it's definitely something that Ha acknowledges. He points out that while concentration can lead to these periods of, really strong performance, it also raises some concerns about long-term stability and resilience. And to give a broader perspective, he compares the U.S. concentration levels to those in other developed economies.
I do appreciate that he's presenting both sides of this argument.
Yeah.
It's not about, saying concentration is good or bad. It's more about understanding, what are the potential benefits and risks, and then making informed decisions based on that knowledge.
Totally. And that's what I love about these deep dives. It's not just about accepting the information, as it's presented. It's about unpacking it, analyzing it, figuring out how it applies to our own, investing decisions.
Right, right. Okay, so we've covered a lot of ground already, but there's still so much to unpack in this interview.
Yeah, for sure.
When we come back for part two, we'll be digging deeper into this fascinating connection between demographics and market trends, specifically how the millennial generation is poised to really shape the investment landscape, in the coming years. So stick around, there's much more to come. So, welcome back. I'm really intrigued by this next topic because in the first part of our deep dive, Dan Ha actually mentioned that demographics are one of the first principles that his firm uses to analyze market direction.
Okay.
And they seem particularly interested in the 30 to 50-year-old age group. What's so special about this demographic?
Well, I mean, just think about what's typically happening in people's lives at that stage. People are buying homes, they're starting families, investing in their careers. They're really driving a lot of economic activity.
Right. It's like that time when you're really starting to hit your stride financially, you've got some earning power, and you're making these big decisions that impact, the economy as a whole.
Exactly. And what's fascinating is that research suggests that, stock returns, especially over the long term, they tend to follow those demographic trends pretty closely.
Mm-hmm.
So the size and the spending power of that 30 to 50 cohort, that can actually give us some clues about where the market might be headed.
So logically, a large and growing cohort of 30 to 50-year-olds would generally be a positive sign for the market.
Historically, yeah, that's been the case. And what makes this particularly relevant right now is that this age group, which is currently dominated by millennials, is projected to keep growing till around 2038.
Wow. So millennials are really going to be a driving force in the markets for quite some time. I guess all the stereotypes about avocado toast and participation trophies don't tell the whole story.
No, not at all. And it's not even just about their numbers either. Millennials, they have a different relationship with technology, with brands, even with consumption itself than previous generations.
Right. They grew up with the internet, smartphones, social media. Their whole world is digital in a way that it just wasn't for older generations.
That's a key point. Understanding those nuances, I think, is really critical for investors. It's not enough to just rely on those traditional economic indicators anymore.
Yeah.
We have to factor in these generational shifts and how they might disrupt those established patterns.
So it's not just about looking at charts and graphs. It's about understanding the people behind those numbers.
Yeah.
And how their behaviors, their preferences, how those are shaping the market.
Precisely. And that's what makes these deep dives so valuable. We're going beyond that surface level and really trying to understand how seemingly disparate factors like demographics, technology, globalization, how all of those are interconnected.
This is all fascinating, but I'm wondering how can individual investors like myself actually apply these insights to our own portfolios?
Yeah, that's the million-dollar question, isn't it? And while there's no, magic formula, I think being aware of these trends, it can definitely help you make more informed decisions.
Okay. Could you give me an example? Let's say I'm thinking about how the millennial generation's spending power might influence my investment strategy. What would be a practical application of that knowledge?
Well, you might start by researching sectors that are positioned to benefit from millennial spending habits.
Okay.
Think about industries like e-commerce, technology, sustainable products, experiences. Those are areas where millennials are likely to have a significant impact as their purchasing power continues to grow.
So it's about identifying the companies and industries that are catering to the needs and preferences of this rising generation. That makes a lot of sense.
Exactly. It's about adapting your strategy to the changing market landscape. Remember, the market is constantly evolving. And our approach to investing, it should evolve right along with it.
I'm starting to see how, these big picture ideas can actually translate into concrete actions.
Yeah.
I'm realizing that investing is a lot more dynamic and multifaceted than I initially thought.
It really is. It's not just about picking stocks and hoping for the best. It's about understanding, all the forces that are at play, doing your research and making informed decisions based on the best available information.
It's like a constant learning process.
Yeah.
The more you learn, the more you realize how much more there is to learn.
That's so true. And that's what makes it so exciting. We're always learning, we're always adapting, always striving to understand the market better.
It's like we're building our own mental models of how the market works.
Hmm.
And each new piece of information helps us refine those models and make them more accurate.
I love that analogy. Speaking of mental models, let's maybe loop back to a point that Dan Ha made earlier about the difference between market perception and reality.
You mean how the market can sometimes get caught up in the hype and, react emotionally to headlines, even if those headlines don't necessarily reflect the underlying fundamentals of the economy or individual companies?
Exactly. The market, it can be so fickle. It's driven by fear and greed, and those emotions, they can sometimes really cloud our judgment and lead to, irrational decisions.
So as investors, we have to be able to see through all that noise and just focus on the things that truly matter. Company earnings, economic growth, technological innovation, those are the factors that really drive long-term value.
And that's where all these, insights that we've gained from Dan Ha's interview become so valuable. They help us, develop this framework for understanding the market's complexities, for recognizing patterns, and ultimately for making more strategic investment choices.
It's like being a detective, right? Piecing together the clues,
Yeah.
separating fact from fiction, and using our judgment to make decisions that are based on, evidence rather than emotion.
That's a great way to put it. And as we wrap up this deep dive, I hope our listeners feel empowered by the knowledge that they've gained. We've covered a lot of ground, from global trends and demographic shifts to, the nuances of international investing and even the psychology of market.
Yeah, we've covered a lot, but we're not done yet. In part 3, we're going to bring it all together, and we'll discuss some practical steps that you can actually take to apply these insights to your own investment journey. So stick with us. We've got more to explore. Okay, so we're back for the final part of our deep dive into Dan Ha's market insights. And we've explored some pretty complex concepts, from global trends and demographics to the psychology of the market. So now let's talk about what this all means for us as individual investors. Like, where do we go from here?
Well, I think the key takeaway from this whole conversation is the importance of being an informed and an engaged investor. Like, it's not enough to just blindly follow the crowd or react emotionally to headlines.
You're saying we need to be, proactive, do our own research, make decisions based on, a solid understanding of the market and our own investment goals.
Exactly. Remember what Dan Ha said at the beginning about the difference between, market perception and reality. I mean, that's so crucial. We have to be able to look beyond the hype and the noise and focus on those underlying factors that really, drive long-term value.
So instead of chasing, short-term gains or panicking when the market dips, we should be focused on, building a portfolio that really aligns with our long-term financial goals and our risk tolerance.
100%. And, that portfolio, it might look different for everyone. It depends on your individual circumstances, your time horizon, and your comfort level with risk.
This deep dive has definitely given me a lot to think about. It's highlighted the importance of, staying informed about global events, understanding demographic trends, and just being aware of those psychological factors that can really influence market behavior.
And don't forget about those practical considerations, like managing foreign exchange risk if you're investing internationally, or thinking about how, that lengthening business cycle might impact your long-term strategy.
Yeah, it's a lot to take in, but in a good way. It's made me realize that investing isn't just about picking stocks. It's about understanding, kind of that complex interplay of forces that shape the market, and then, making decisions that are aligned with our own unique financial goals.
And remember, this is an ongoing journey. The market is constantly evolving, so we need to stay curious, keep learning, and adapt our strategies as needed.
It's almost like a game, but with real world stakes.
Yeah.
And the more we understand, the rules of the game, the better equipped we'll be to actually play it successfully.
That's such a great analogy. And just like in any game, the more you practice, the better you get. So keep learning, keep exploring, and keep refining your your investment approach.
Well, this deep dive has been incredibly insightful. I feel like I've gained a whole new perspective on the market and my role as an investor.
I'm so glad to hear that. And remember, this is just the beginning. There's a whole world of financial knowledge out there, just waiting to be discovered.
So to all our listeners out there, keep diving deep, keep asking questions, and never stop learning.
And most importantly, have fun along the way. After all, investing should be about building a brighter future, not just stressing over numbers.
That's a great note to end on. Thanks for joining us on this deep dive, and we'll see you next time.